Okay, we'll kick off. My name is Graeme Bibby. I'm Chief Investment Officer, and we're here today to introduce you to the Westpoint Haben Trust, which is a retail shopping centre, major retail shopping centre in Western Sydney. The manager is Haben, and here on the call today to go through the opportunity with you is Ben Finger, who's CEO, and Melissa Kingham, who is Head of Funds Management at Haben. The format will be 20 minutes of presentation, and then we'll have a Q&A session. So asking you to put your questions into the chat, and then we'll select those questions to ask of Ben and Melissa, and then we'll wrap up after that. I may have a couple of points to conclude. So with that, we'll introduce you to Ben and Melissa to present the opportunity.
Thank you very much for the introduction, Graeme. Thank you for having both myself and Melissa here to present the Westpoint opportunity. We're really excited to present this opportunity. As a business, this is one that really excites us because it's the type of deal that doesn't pop up too often. I've just shared my screen with everyone, which I hope they can see. What's really compelling about this opportunity, and just for full context, when it comes to shopping centre world, which is the space that we specialise in and have been specialising in for 15 years, there's really three sort of main categories of shopping centres. You've got your sort of typical small neighbourhood shopping centres, which is a supermarket or two supermarkets with some specialty shops. The next tier up would be your sub-regional shopping centres, which are your supermarkets with a discount department store like a Kmart or Target, and then your specialty shops. And then your top tier of shopping centre, at the top of the hierarchy, is what's called your regional shopping centre, and your major regional and super regional shopping centres. So this is at the top end of that scale. It straddles somewhere between what would be called a major or a super regional shopping centre. And effectively in Metro Sydney, which is where this asset sits, there's only 8 of these assets. They're very much trophy bits of real estate. And the last of these to be built was some 20 to 30 years ago. There's really no opportunity to put any more within those sort of major capital markets. All of them are owned by your big listed REITs, like your Westfields, Vicinities, GPTs. And the significance of this transaction is that this would be the first time in over 20 years that a regional shopping centre in Metro Sydney has been sold at a 100% interest. And put simply, you don't really want to sell these assets because you can't replace them. And the significance of the opportunity is that this would be the first time that something like this would be offered to the private markets. And as I mentioned, to get access to it, you typically have to buy a Westfield or a Vicinity share or a GPT share. So to be able to offer something like this to the private markets, we're really proud of and really excited at the opportunity. And really, it's just a reflection of the opportunity at this current point in time in the cycle, where groups like ourselves that have the ability to be able to execute can take advantage of a bit of a dislocation within the market. And the market timing couldn't really be better, because we're really at the start of the emergence of a lot of capital starting to come back into retail, but really not meaningful capital that could take a deal down like this. And the reason we're able to do a deal like this is because, one, this is an area that we specialise in, but two, we've managed to join up with an American institutional capital partner in Hines, who are the largest privately owned global asset manager, to do the deal. And that's sort of the background to where we are and how we have the opportunity. In terms of why we really like this asset, as I mentioned, retail is very much getting back up on the radar for where capital wants to go to. And when capital re-emerges within a sector, everyone wants their wish list. They want it to tick all the boxes. And really, to summarise, this asset does that. And it does it in sort of the three categories, being one, location. I mentioned it's in Metro Sydney. It's in Blacktown, which is the fastest and the largest growing LGA within New South Wales. Two is the immense amount of infrastructure that the site has, the shopping centre site has next to it and around it. And if you look here at this image, you can see you've got the train station right next to it. What you can't see, which sits underneath the asset, is a major bus terminal. And when this centre was developed, it enclosed the road And in doing so, it enclosed a major bus terminal of 10 stops. So anyone taking the bus coming into Blacktown has to come out through the shopping centre. So there's an amazing connection between the train and the bus. So an immense amount of public, transport feeding in and out of this shopping centre. As you can also see, you've got the university right next door, which just went through an expansion. The hospital, the stone's throw away, which just went through an expansion. And then if you look more, I guess, at a helicopter view of what's happening in Western Sydney, we don't know this factually, but we don't know one other area in Australia that has this much amount of government infrastructure expenditure happening in one location to the tune of almost $19 billion. And the main components of that being the new metro line, as well as Sydney's second airport. And of course, all of those things will feed into strong population growth, strong employment growth, which really from a retail perspective is exactly what you want, because that'll all feed through to trade area expenditure, and our favorite thing is, as landlords, of course, rental growth. And then in terms of sort of the final piece of the puzzle that got us really excited about this opportunity, you can see that the outline of the site, it comes with 2 parcels. It's the main shopping centre site, which my cursor is going over. And then it's this additional parcel of land we call the Kmart site, which is across the road. And the exciting thing about that opportunity is that through a longer term lease negotiation, there's a pathway to be able to get Kmart to go back into the shopping centre, which will be great for the centre to capture those sales. But B, once they're in there, we've freed up a 1.7 hectare development site right in the heart of Blacktown, which as of right can accommodate up to 1,000 apartments. So a significant development, which we won't undertake as a business, but what we do as a business is we will do the deal to get Kmart in there, and we will get the approval for the apartments, and then we will sell that off to a developer. And the increased land value as a development site is significantly more than it is just as a Kmart site. So that's a really compelling feature from a value add perspective. And then I'd say probably the icing on top of the cake is really what this site sits next to. And if you can see again where my cursor is going over, you've got this green hashed area, one right next to the Kmart site and one across the road. Those 2 sites combined were acquired by Walker Corp last year. And I'm sure all of you are familiar with the name Walker within Australia as being one of our largest privately owned developers, but not just a developer per se, a developer that specialises in urban regeneration projects. And that's what makes this so special. They've undertaken this development. They've bought the site. It's a JV between themselves and Blacktown Council, and it's set to be a massive urban regeneration project right in the heart of Blacktown town centre and right next to our shopping centre, due to be complete in 5 years. And that particular development will see it be completed, as I mentioned, in 5 years, with a brand new town centre, a $2 billion end value, including offices, medical research lab, private hospital. It'll bring an additional 4,500 workers to Blacktown Town Centre. And for context, that's a 50% increase on the amount of workers that come into the town centre already. And from our perspective, that's a massive kick to the economy within Blacktown. Those are numbers that we haven't even factored into in terms of what that does to sales within the shopping centre. So a huge added bonus over and above everything that we mentioned. So that's the sort of framework to why we really like the site. If I just scroll through a bunch of these pages, and I'll be mindful to leave enough time for some questions at the end. Part of the other sort of really compelling features of this asset, and if I just sort of focus on the main points here today, is the limited competition within this trade area. And if you look on the right where my cursor is once again, you'll see what we classify as a trade area map. And that trade area map effectively defines who are the people that are spending in this shopping centre and where do they come from. And importantly, it's got a very limited competition landscape. There's no possibility of any major competition coming into the trade area. And again, importantly, this particular shopping centre already has a trade area population that it draws on that is 60% larger than a typical regional shopping centre. And when you consider that, there's no new major competition coming into the trade area, and consider the fact that Blacktown is the fastest growing local government area within New South Wales. again, coming to our favorite thing, all of this is going to lead to super strong sales growth, retail sales within the trade area, and be a real positive impact for this particular shopping centre. The importance of this particular page that I've paused on here is tracking you through sales growth. And in the last few years, there's been an immense amount of sales growth that we've seen come through this shopping centre off the back of a poorer period. The particular asset has had a huge amount of capex being deployed into the asset over the last 5 years, which is, again, to our benefit coming in when we're coming in now, because what's happened is the current landlord has expended a massive amount of money in a couple of areas, one being the car park, which unfortunately for them, they had to replace to brand new because it had structural issues. So hence the reason why sales dropped during that period, which is a natural thing. If a centre doesn't have car park, of course, it can't generate sales. But from our benefit, we've now got a brand new car park, so there's no capex to be deployed there. And two, they spend an enormous amount of money having to provide a solution to where was the mire within this shopping centre. And again, from our perspective, it's been completely de-risked. They've deployed an enormous amount of capital, and the end result is a significantly better outcome in the sense that they've put in 6 different mini majors where the mire once occupied. Collectively, those tenancies are providing better sales, better foot traffic, better rent for the shopping centre. Off the back of that, they did a major cosmetic upgrade. And as you can see, what's happened, sales are stronger in the centre than they've ever been. And we've continued tracking the sales through to May and June 24. And we can see that it's even grown from 650 to 670 to 680 million annual sales in the shopping centre, which is an amazing result. And also just tracking it over the last 12 months, we can see that sales within the shopping centre have grown somewhere between 8 to 10%, which is really, quite amazing when you consider, where the centre was and how it's trading and comparing it to the benchmark within Australia. So it's really in a good position. The overall tenancy mix, it's represented by all the big national brands, which is great. At an anchor tenant level, as well as at a specialty tenancy level, where we've got 87% of the tenancies represented by ASX listed and national tenancies. And in terms of the general mix and the general weighting, it's got a very, very heavy weighting to food and services. From our perspective, it's a real big positive and makes it a much more defensive asset. And typically when you look at these large, super regional, major regional shopping centres, they would never typically have such a high weighting towards food and services. They're typically heavier weighted towards fashion and entertainment. This centre has done it really well and weighted it really well to food and services. And the reason being, it's got such a great layout to navigate, which makes it a very easy customer experience, hence the reason they can leverage off that convenient food and service well within this asset. In terms of the value add strategy, and I'll leave this more for Q&A if need be, but in terms of the way we think about these assets, Haben as a business, we very much consider ourselves as a value add buyer and manager of these assets. We currently own 12 of these across the east coast of Australia, and sitting behind just myself and Melissa here, there's 110 people within the business. We operate all of these assets ourselves. We have a fully integrated model, everything from centre services, centre management, operations facility, leasing management, development management and whatnot. And the ability of being able to have the benefit, I should say, of being able to have the in-house management team, it enables us to go in and really take an active approach. And this asset will be no different. We've assessed this asset during a due diligence perspective, and we've identified a number of areas where we can go in, improve revenue, reduce costs, as well as drive better sales, leading to better rental across the asset through prudent capital deployment. In terms of the look and feel, I mentioned they'd spent a lot of money recently, and these images are sort of just a good point to stop and stare. You can see how well it had been looked after, and more recently through that major capex that they spent on the asset. It presents incredibly well. On the bottom right here, that's one of 12 bathrooms. Every single one of them were lifted to that exact same standard throughout the shopping centre. So again, reducing our need to have to spend major capex leading into the future. And then of course, the other main benefit, there's massive tax deferral, tax depreciation benefits that we are the beneficiary of, and specifically that will be 100% tax deferred on the first 3 years of distributions, and a conservative average of 65% across the duration of the investment term. Importantly, most of these acquisitions, a lot of the good work is done up front in how well we buy these assets. And because this is all we do, shopping centres, we're able to sort of, focus on the right acquisitions. And this one is exactly one of those. We've analysed the market over the last 15 years in terms of what we would consider a comparable bucket of sales. And I started off by saying there's been no 100% interest sales, but what we have been able to track is partial interest sales of comparable assets. And the two main markets that we follow for this, of course, is Sydney and Melbourne, because they're most comparable capital markets in Australia. And what that showed us looking at sales evidence was that a typical asset like this has been sold at $12,000 a square metre. We're buying this at $8,000 a square metre. So a significant discount to where these assets have typically traded. And then in terms of cap rate, these assets have traditionally traded at 4.9%. And even today, for one of our other clients, we were looking at where Westfield and the like are holding their comparable assets. And on average, they're sitting in the low fives. We're buying this asset at 6.4%. So again, a significantly softer cap rate, just showing how well this asset's being bought at. And then the other sort of benchmark we use is discount to replacement cost. And this particular asset is being acquired at a 40% discount to replacement cost. In terms of most of the value, where that's coming from, importantly, a lot of it's through rental and rental growth, which you can see here. There's a massive rent driver within this asset, which makes it really compelling for us, and great opportunity to work on the tenants that are good performing, which is the majority of them, expand them and drive their rent in line with where their sales are to get the appropriate market outcome, as well as the Kmart land sale, selling the asset in a market that's more reflective of where they've traditionally traded, as well as, capital deployment to drive extra revenue is how we sort of drive our total IRR outcome. And then just to finish, the last few slides focusing on the sort of opportunity. On the left here, straight out of Blacktown Council's 2050 vision. It looks super futuristic, and we don't expect Blacktown to look like that, but you can see we've marked out where our site sits in the middle of that. And I guess the important takeaway that we take from this is that we've got a council that's going to be super supportive of our development application and not get in the way, because if that's the vision that they want to see, well, we're fitting right into that vision. And then on the bottom right is from our planner, who marked out how we can get our apartment outcome through various blocks, which importantly makes it easier from a sell down perspective to an incoming purchaser. And then the last couple of slides focus on the Walker Corp development, what it will look like, what the mix will look like. This is straight out of their own website. For anyone that's interested, you can go to Blacktown Quarter. And then the last image, their hero shot of what they think that new town centre will look like on completion. And on the bottom right here is our shopping centre. So you can see how we're such a pivotal part of what they will do, as well as how we will benefit strongly from what they do. And that's where I'll probably pause, Graeme, and just leave some time for Q&A.
Thank you, Ben. So I'll maybe start off with a couple of questions. Please, if there's other questions, put them in the chat. We haven't seen too much there yet. But one of the questions that I'd imagine people would have is that retail has had its challenges, and there's been a couple of things there, like the trend to online sales, and also the adjustment of interest rates as well. So maybe those couple of things. What are you observing about both of those things and how it's impacted retail shopping centres at this point?
It's a great question. I might start, and Melissa, feel free to jump in at any stage. So probably if we take a step back, we call it the online Amazon effect sort of kicked into gear about 7 years ago, and sort of had a massive, profound impact on retail worldwide, I would say. And there was a massive fear. And if you think about online, you think about effectively a new competitor coming into the trade area. If we fast forward today, I think what we've seen is everyone's very comfortable with what the impacts of online mean. We know what percentage of sales that reflects in Australia. In Australia, that's 15% of sales. In America, it's higher. It's 20% of sales in America. Why is it higher in America? They've got better distribution capabilities because it's a more densely populated country. Our market's probably more comparable to the Canadian market. So we follow that quite a bit and see how that's going. But the important thing that you're seeing worldwide now is, whilst you might have had immediately really fast growth, it plateaued. COVID accelerated that significantly, and then that slowed right back down. What we're seeing across the globe now is that growth is very much slowed, okay? And you're even seeing a reverse effect now. All those businesses that went online, right, called it bricks to clicks, you're now seeing clicks to bricks. You're seeing the reverse trend. And online businesses are realizing that they can't grow unless they get footprints inside physical locations. The other thing that's happened, of course, is that no one's been building any new shopping centres, okay? No one's been building any new shopping centres for a really long period of time. So the net absorption factor is actually really getting to the point now where there's almost going to be an undersupply of retail at a very soon point in time in the future. You overlay that with a whole lot of population growth, which is what you're actually starting to see now. Rents are starting to grow across the board, okay? So America has started to see that trend. Australia's starting to see that trend. And the interesting takeaway from that, of course, is if you look at who our JV partner is in this particular deal, it's an American institutional capital partner. The most amount of interest that we've had from capital offshore, because we spend a lot of time talking to institutional capital, is actually American capital. And they're seeing the trend happen there first. And they're looking, well, what are the other markets that we can go into now and get good deals? Because we think retail is actually in a really good place. And that's coming out of America. And the interesting thing with all of that is America's market is in a different position to Australia. Australia has a third less the amount of retail floor area than America does per capita. So we're in a much healthier position than they are. In addition to that, we anchor our centres significantly better than theirs with food and services. So hence the reason why that capital from America is really flowing into Australia. So to answer your question in a roundabout way, we think retail is actually in a really good point at this point in time, which is evidenced by the rental growth. And that's an exciting point in time for retail.
Excellent, thank you. Was a question that's come into the chat. So the fund is a 7-year term. So what is the expected sort of exit strategy for the fund?
So ultimately, it's to exit to a bigger and uglier group than a Haben, that's for sure. We've got we carry, which I wish I should have brought on the screen here up front, a great map that shows, if you look at, again, the capital markets, Melbourne, Brisbane, even if you want to include Brisbane and Perth, who are the owners of all of these large, major regional, super regional shopping centres? There's not one private owner amongst it. It's all institutional real estate, whether it be your listed REITs or your unlisted institutional real estate owners. So ultimately, these are the groups that are going to come back in and buy assets like this. And we've just started to see that trend emerge. Vicinity, who have been out of the market for 7 years, have just gone and made their first acquisition. Smaller than this because they don't quite have the bandwidth yet to jump on a really big asset. So your likes of your Vicinities, your Westfields, your GPTs, all those types of groups will be back buying. The other category of buyer that we've started to see in the last few years emerge is the Aussie super funds. So the Aussie super funds have traditionally sat in these commingled funds managed by institutional capital. What's happened and what's emerged over the last few years is they've gotten bigger and bigger and bigger, and they no longer want to be one of this big commingled fund. They want to be either 25 or 100% direct owners of these assets. This is the reason why we've been able to buy something like this, because that particular fund had redemptions in it, with those groups wanting to come out. But those groups are re-emerging. Those groups are building out their own asset management capabilities, and they're going to become a big competitor within the landscape. And then I guess the final tier will be, similar to our JV partner Hines, who are more value add sort of buyer at the moment, but it's when that core capital, from offshore wants to come into Australia and they want to buy the trophy bits of real estate. Those are effectively our 3 tiers and 3 categories of buyers that we'll be selling back to.
I might just add there as well, with the super funds, a lot of them now are focusing on mixed-use development in their own right. And there's the opportunity that the development site has to deliver 1,000 apartments. That's as of right. That doesn't include extra height for affordable housing or social housing. And that's where they're really playing at the moment, in these mixed-use areas. Stable income with the development upside, with the ability to have the social part of the ESG covered by offering this affordable housing and social housing. So we think that's a real opportunity at the end for as part of the exit.
Thanks, Ben. And to sort of reinforce that from my point of view, I talk to a lot of Australian super fund people, CEOs and heads of asset class, and we're also seeing mergers of super funds, which means that sometimes they've got to sell, and they're rebalancing. So that's been an impact. But I think to reinforce the point of that they want to go direct, they don't want to be commingled. They want to, those property teams to manage directly so they can help reduce their fees as well.
Yep.
That's a trend that we're seeing. Got a couple of other questions. One is, the ability to purchase this at such a discount. There's a comment that it, looks like at a 8,000 per square meter compared to an average of 12,000 per square meter. And that's a broad metric, but in aggregate, why such a discount that you're able to acquire this for?
The simple sort of answer to that is just scarcity of buyers, and they need to sell, and they need to satisfy a requirement to get capital back to their investors. So they have to deal with where the market is.
That's good. So there's another question on do you have some comments on the cultural diversity in the Blacktown area and future cultural growth and their shopping preferences?
Yeah, actually, what was really profound during the demographic report that we got on this asset, it's like a 110-page report covering everything you could imagine in the Blacktown LGA in this centre. It had the most diverse demographic I've seen on any location we've looked at any asset. It was represented by over 110 different nationalities, which actually from a shopping centre landlord's perspective is like a leasing person's dream, because it means you don't have to play to just one segment in the market. We can actually play to all segments in the market. Now, clearly, obviously, it's still got a higher proportion of, your average sort of Australian. But the fact that you've got all these other nationalities represented there means you can also mix the tenancies in quite a diverse way to make sure that you cover off on the entire market, to make sure you don't have slippage within your sales, and to make sure they don't go to a competitor's centre. So from that perspective, we think it's a real bonus how diverse that community is within Blacktown.
I've also noticed within the tenancy mix, and that's something as a specialist that you do really well, there's a trend to develop more services for the local community. Perhaps expand on that a little bit.
Yeah, so a key change in shopping centres over the last 10 years, you'd say, Melissa, 10 years or so, has been moving away from your traditional retail and getting as much services as you can as possible. Often those services, from a landlord's perspective, it's not about a rental game there. It's about making sure you have everything that the community need so that they don't need to go anywhere else. And once they're in there, then you've got your captive audience, of course, and they start spending elsewhere in the shopping centre. And this particular asset has some services. There's a great opportunity to actually go above and beyond and add to the good work that QIC have done on the asset there. And so we've identified a number of different services that we would love to put in the shopping centre. We think there's a good missed opportunity there on focusing on that sort of after school kids care, education focus. And we've got a great location where we'd like to execute that on, which is probably the only part of the shopping centre that's not sitting in the main run. It's actually a little bit off to the side. It's still got great access, which means parents can come and drop kids off and then go do what they need to do. And it's a quieter corner, which means we also don't need to get as much rent out of it, but at the same time, it'll fill an empty part of the shopping centre. So yeah, we love executing on those types of opportunities.
And conscious of time, we're probably near at the end to wrap up. There's one very quick one, which I think is covered in the either in the information memorandum or the presentation material on cap rates, capitalisation rates. For those who aren't familiar with that, that's the effective yield in current market. Where is the cap rate of regional centres over the past few years, and what are you buying at? What do you assume you're exiting at? I think that was on a previous slide though.
Yeah, so these types of assets, as I mentioned, haven't traded. So there's been no major trades in the last couple of years. Probably the only significant trade worth mentioning would be Chatswood Chase, which is a regional shopping centre in Metro Sydney. That was a bit of a development opportunity for Vicinity. They ended up buying their JV out, but that was a sub 6% cap rate. And keeping in mind that was then a development. They needed to then go and spend, $300-400 million on executing the opportunity. So probably not what I'll call it a comparable sort of bit of sales evidence. If we go back a little bit further and look at the Pacific Fair and Macquarie Centre shopping centre trades, they'd be your most comparable in the last few years. That sort of sat in the late 4.75%, 5% cap rate range, to give you some sort of context. So those are probably the more recent ones. Then, of course, we would rely on valuations. And I think I might have mentioned earlier, we've been looking at where Westfield and Vicinity are holding their comparable assets. And when I say comparable, we're talking about your major and your super regional and your metro locations. And so those ones are sitting in below 5% sort of cap rate range. So that's kind of where they've always sat. I mean, if you go to the extreme end, of course, and your Chadstones and your Bondi Junctions, which this is not, of course, they held those things at even, more aggressive cap rates in the low 4 type range. So yeah, we're buying this really well at a 6.4% cap rate when you consider all that evidence. And in terms of where we exit, we believe we should be exiting similarly to where the last 15-year average for these assets have sat, which is at the 5% cap rate range.
Yeah, I think we should wrap up there. There is a question which I'll just address very, very briefly. So I guess at the end of the period, you're buying at a discounted cap rate now. What if that environment exists in the future as well? How would you manage that? And then post that, just really wrap up with the key points. The why as to this investment, just in a very quick summary.
So ultimately, if the cap rate position stayed whole, that's what makes this asset so compelling. We sort of see the risk return reward on this asset really well adjusted. So we've done the analysis on cap rate staying the same, and we're still looking at a double digit, low teen type IRR. So that's what makes this a really compelling investment opportunity. So even if we didn't get that cap rate compression, we're still looking at most of the value on this particular asset coming out of rent growth, as well as what we can do on the Kmart land sale, as well as all the different value add opportunities within the asset. So even still, it holds a really good return from a very low risk position. We always have the option of waiting additional period of time till that market softens. Or tightens, I should say, and more aggressive cap rates start coming into play. But we ultimately believe that, in the space of a 12 to 24 month period, what we'll see is as interest rates start to fall a little bit, that cap rate market will start to tighten. That will be one aspect. The other aspect, of course, is all that additional interest that's coming back into retail. And the more buyers that become or enter the space, the more competition, cap rate starts to compress. And we've already started to see that in any event in the last 12 months. So if we were to fast forward, our view on the world is that within the next 12 to 24 months, we're going to start to see a lot more competition come back into the space. As I mentioned earlier, Vicinity have just made their first acquisition within, 7 years. Region Group, the former Shopping Centres Australia, they've just made their first acquisition in quite a few years. We're seeing a lot of other fund managers who typically didn't play in retail start to come into this space. And again, I come back to the perfect example, our JV partner from America who's playing in this space. So there's a lot of capital coming in, and all that pressure is going to build into tighter cap rate environments. So that's sort of how we see the world there. But yes, just to wrap, as I sort of started with, I think sort of the best place to sort of finish is there, really just ticks all the boxes for us in terms of, being in the right location, having all that infrastructure around the asset, as well as that mixed use opportunity, and buying it at the right price is what makes this a really compelling investment opportunity.
Excellent. Thanks, Ben. And I would just like to reflect from our side. We've done extensive due diligence into this opportunity, also into Haben, the manager. So I think on the asset, we support the statements that you're saying, and we've done a lot of further due diligence beyond that with legal, operational, financial due diligence alongside investment due diligence. And I think with capability of the manager, that's very strong. We've got to know Haben over the last couple of years and seen other transactions that you've done and gotten really comfortable with you as a specialist, and we like that aspect. And from the right time in the cycle for retail is attractive as those headwinds have bottomed out, and you're actually seeing rising rentals. And I think the other thing for investors to bear in mind is there's a very strong inflation linkage or close inflation linkage of rental tenancies. So that's very attractive, and we see the interest rate cycle as as the RBA starts to cut rates. If that's sooner or later, likely interest rates will be lower here, that will support valuations going forward. So that's sort of our view. So we're very supportive of this opportunity. And I'd also like to say, if you've got other questions, please send them to us. We'll put together a Q&A, and we'll check those off with Haben and put that together in a Q&A document that you can all access. Thanks very much, Ben and Melissa. Great to talk today. And concluding that, if you're an advisor or client, please contact your advisor, or if you've got questions for us directly, please contact us, and we're happy to pass on those direct questions to Haben. Thank you, Ben, and thank you, Melissa.
Thank you very much for the
Thank you.
opportunity. And thanks for everyone listening in today. Thank you.
Thank you.
Thank you. Bye.